What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is October 10th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's Macro Monday, we have what may just very well be a make-or-break moment for Bitcoin's price here in the near term, with the upcoming release of the CPI report for September that's coming up this Thursday. Now, the reason why this is such an important event is not only due to the fact that we've seen this event have major price movements for Bitcoin. The last one pushed Bitcoin down nearly 10% in a single day. But on top of that as well, both Bitcoin and crypto as a whole, as well as the stock market, are all resting near their relative lows for this bear market that we've been in. And the question remains whether or not the bulls can start to take charge with a positive surprise on the CPI, or if we're ready to drag down towards lower levels. I'm going to try to answer that question with the data we have here today to be prepared for that upcoming Thursday event. If you happen to like the video, drop a like, consider subscribing, and I hope you guys will stick tuned on this one. It's going to be a good one. So first off, let's just go ahead and talk about what the price is telling us here. We're going to look at some of the macro data, some of the macro events going on, but let's just go ahead and take a look at Bitcoin and Ethereum here on the dollar chart. We are far and extended away from any potential retest here of the 200-day or 200-day EMA moving averages. We've continued to set in lower highs here in a consistent support range. I don't mean to be negative here, guys, but this is a typical descending triangle. And until we actually get a breach of both this red line and the upper band of the consolidation or potential accumulation channel that many people are hoping this is, I cannot remain bullish on this. This tells me that the market has massive sell side pressure, either asks on the order book or essentially market order flow to the downside here. People selling more than buying here. So until we get that kind of breakthrough here, I'm not looking for any trades up here into the moving averages or potential consideration that we bottomed yet. Another thing as well, take a look here at Ethereum, right? Ethereum, which has been generally a market leader here during this fearful bear market, right, had a great rally here throughout the summer during that relief rally, capital accumulated towards it, but now it's starting to stagnate sideways here and underperform against Bitcoin. And it looks like it's at a minimum ready to come down here towards this $1,000 mark here, seeing another 30% decline here for its price. Okay, so that's what I'm seeing right now when I look at the charts. But one thing that I'll give to the bulls here is taking a look at our partner tool, Bookmap. Right? So Bookmap here over the past week has actually been registering across its unique tool, which is known as multi-book. It aggregates all the liquidity from major exchanges like FTX and other players like Coinbase to try to get an understanding of where the liquidity is in the market. And when we take a look here at the USD Tether balance sheet, right, across all the different books for the exchanges, which is Binance, FTX, and Huobi, we can see here that there's actually positive market flow here, even as price has been relatively neutral here. So this is one thing that I gotta say the bulls are looking good on, and there is some bid support coming in here, especially I think as we come in preparation here for the upcoming CPI report. Some bulls coming in to possibly soften the blow here if we do get a big market sell-off here, if we get a lot of people starting to sell into that event. So these are some of the things in the technicals. I'll say that they're relatively mixed right now. While I do believe that the price action speaks louder than practically anything else, I will say though, I do like seeing the market order flow here starting to turn a little bit positive. The bulls need to keep this up on a week-by-week basis, and that's why we focus here on the weekly order flow. Now, if you guys want to get access to this kind of information, you can check out Bookmap at the link down below in the description. It's a great tool. I use it in my arsenal of trading for when I find whether or not there's bottoms in the markets or tops and when momentum is weakening or strengthening. But it's a good thing to keep an eye on here. So let's go ahead and talk a little bit here about the first major thing we need to discuss. And this is the upcoming CPI numbers release that's going to be coming out at 8:30 a.m. Eastern Standard Time on October 13th. Now, it's important to understand that, as with all indicators here, as it takes time to comprise data and get an actual reading, this is the data for September. But this is still relative information here for the Fed, because the Federal Reserve needs to see us reach down to two key things. They need to see that inflation is getting down to a 2% annualized target, and that is their key goal here. Until that is met, the Federal Reserve is very unlikely to pivot. And on top of that, they are going to need to see softening or weakening in the labor market, like a weakening trend. And this essentially means here that we need to see higher rates of unemployment and lower amounts of job openings. Now, if you guys remember from the last Macro Monday special, we talked a little bit about these discussion points here. We talked about the fact here that core PCE inflation or CPI inflation, doesn't matter which one you're looking at, all of them are still highly elevated here. And the PCE as well as CPI still ticked up month over month here, back last month in August, right? So these September numbers are going to be very important. Are we going to see a major decline here down below where basically the PCE sees a major month over month decline, or is it remaining relatively neutral and elevated here? Because the Fed at a minimum, this is a much more easier indicator to get down to 2%. The Fed needs to bring this metric of 4.91% on a year-over-year basis down to 2%. That is its target here, so we need to keep that in mind. And on top of that as well, we need to take a look at the jobs report that came out this past week, because while a lot of people were looking for a very positive upset, meaning that essentially, ironically enough, bad news would be good news if we had a higher amount of new jobs being created. In this case, it would actually be bad news, whereas if we had a lower creation of jobs, it would be good news because it would showcase that the labor market is softening, therefore the Fed could potentially pivot. This is the unfortunate hope that a lot of people have. People want to see a weakening jobs market, which helps the broader amount of people in order to benefit asset markets. Let that sink in here. That's the kind of hopium that's going on here. It's the kind of cynical thinking that is going to get a lot of people trapped. But the bulls, unfortunately, had their hopes shattered. There was only 263 jobs being created in the economy. And while that might not sound so great compared to previous months, at the same time, this was weaker. Just basically slightly under the expectations here. This was not some major deviation. While we had 350,000 jobs in August, most of the experts were calling for around 270,000 jobs, 280,000 jobs. Most economists were calling for this. So this wasn't some major positive upside. It was about 10,000 jobs below most estimates, pretty much in line with what people were expecting. We didn't get this major positive upset, and because of that, considering that plus inflation, we saw the two gains that people got so excited about as a potential bottom here, double bottom, in equity prices here on October 3rd and October 4th was completely reversed, down 3.8% on the NASDAQ alone here. Now, to put this in perspective, this is the biggest move to the downside here since back on September 13th. So basically, this one trading day here on October 7th on Friday closed down all of the gains here that people were seeing as a sign of hope here that the bulls could potentially come back, that we could get another summer relief rally, the Fed could start to pivot. I think it's starting to become growingly obvious here, at least under current circumstances, that the Fed cannot do this. It needs to continue on pace to cool inflation. There's simply still too much demand in the economy comparative to supply. And we're going to talk about that as we go through it here, because when we look at a variety of different metrics here, we start to really get a clear picture. It's not rocket science. I don't want to come across as some Nostradamus or some market expert here, guys, right? At the end of the day, I'm working with what I've got here, and it's the tools that everyone has access to. People have different perspectives, and that's completely fine, but we need to understand, essentially speaking, what's going on here. The first thing we need to understand is that the Federal Reserve's number one goal out of these two things, not just the jobs market, but really inflation. Inflation is the number one target here. And the Fed has been having a difficult time taking this down here, considering that they've already been increasing at 75 basis point increases per FOMC meeting, usually around every 2 months. So essentially speaking, this probably means the Fed is going to have to get more aggressive. It's going to have to do 100 basis point increases, which again has been starting to be murmured each and every meeting a little bit more and more. And I think the Fed will eventually, if it wants to do the right thing, is going to come to that point where it does do the 100 basis point increase. It goes a little bit more aggressive, right? And that means that the already 3.25% federal funds rate, the highest level we've seen since back here in 2007, as we were going through the correction and the collapse in 2008, right? In order to try to soften the economy, we are now accelerating higher, and the target rate is somewhere in this band between 4.5 to 5%. So we're at a minimum going up to where we were here in 2006, or back here in the 1990s. Some of the highest interest rates we've seen in a near decade of almost 0% cost to capital. All right. So that's important to understand. We have accelerating interest rates. The cost of credit is going to go up. And on top of that, we've also got the reduction of the central bank balance sheet. No matter where we really go here, as we've highlighted, we've got a long way to go. If the Fed just cools down the secondary wave of the 2020 stimulus here that really came into 2021, or if we come down here cutting down half of the gains of the money supply from the post-pandemic era, or if we come down to close down all of that excess capital that was aimed at keeping money circulating through the economy, either way, all of these are going to put us at a minimum towards a 40-50% decline in equities. I would say with a balance sheet reduction to around $7 trillion from a $9 trillion peak, that's going to lead us to that 40% correction in equities. If we get down here at $6 trillion, it's probably going to be about 50% top to bottom correction. And if you get something that rings us down all the way here, but the Fed really has to reduce all this excess liquidity that it put into the system, that is at a minimum going to bring equities down 60-70%. We really haven't had many people talking about the balance sheet. The Fed has avoided this topic. And to be completely honest, for those who are calling for a pivot, I got to say, the Fed, which has been supposedly on autopilot, as it's claimed, has actually not reduced its balance sheet in the month of September. And this is where one of the few areas that we really need to discuss, which is that, is the Fed really serious about cooling inflation? I know some of you out there have that belief. Some of the bulls out there, like, the Fed can't really do this. They're talking out of their rear end. They're not going to be able to tighten as aggressively as possible. Well, if Jerome Powell really wants to get essentially to that 2% inflation target, we're going to be able to see whether or not he's really calling, essentially if he's bluffing or if he's serious, by whether or not here in the month of October we get that balance sheet reduction. Whether or not with this CPI report and the next FOMC meeting, if he's really going to be willing to increase interest rates to 100 basis points, right? Essentially speaking, the longer the Fed drags this out here, right, I can tell you guys, if the Fed just tries to teeter on a tightrope here, it's not going to be good for equities. Essentially speaking, unless the Fed is really willing to stop increasing interest rates and stop the reduction of its balance sheet, full stop, that's the only way equities are really going to start moving higher here. And there's a big reason for this, because as the money supply is contracting, this means there is less credit and capital in the economy to invest in speculative companies, things that create jobs, right? Innovation in the economy, right? And on top of that, with the cost of capital going up here, this means that loans in the economy for businesses are getting more and more expensive. And this is essentially going to knock out businesses that have a certain amount of limited profit margin that get eaten up by financings. What essentially gets known as a company that becomes a zombie company, a company that can't even keep up with the interest rate on its financing to pay back its debt. And this will lead a lot of companies to go bust. Systematically, it happens each and every time. It is mathematically provable because of the cost to borrow capital and the lack of credit circulation and investment in the economy. Now, one big thing here as well, just again to speak to the market turmoil here, we're going to run through a couple different charts here as we try to answer this big question. As volatility is spiking up here, we've really got to ask the big question here. What market signs do we have that either inflation is ramping up or cooling down? And let's try to take a bit more of a neutral take to this, because we need to focus on what measures really can help us in determining whether or not inflation is going up or down. Okay, we really need to get that metric down to 2%, whether you're talking about the PCE or the CPI. The Fed wants to see these indicators dropping sharply. Well, first off here, one key thing we can take a look at here is crude oil. Okay, now crude oil not only has a direct probably 5 to 10% play in the CPI on a personal expenditure basis, but it's also going to play a big role in the cost of other goods and services in the economy. And while it doesn't have a direct month-over-month effect, the longer this stays suspended and is tracking higher, it likely means that inflation is going to move higher as well. And we have seen a massive move higher here, around a $14 acceleration here just in the past few weeks as we stepped into the month of October, back to where we were roughly here in July or through August of this past year, right? This year in 2022. So oil is not looking very good here for the bulls. And on top of that, another food-based commodity that isn't looking good for the bulls is wheat. Month over month, up 10.8% here, and looking like it's ready to start tracking higher, which likely speaks to the macro concerns with the war in Ukraine and the supply chain disruptions that has caused on the world stage. Now, I want to go ahead here, on one positive note for the bulls and talk about the other commodities that we track here. Gotta be honest, everything was actually down month over month here. You're talking about lumber here, down around 12% in the month of September. Positive for helping to reduce the cost of new homes. Definitely a good sign here. Signaling also as well a slowing demand in the housing market, which is a good thing to see. Although lumber is about 7% of the cost of a home. So don't expect it to have a huge net effect. It's just more of a sign here that there's a slowdown in the housing market and the consumer demand. We've got copper as well, which was down another 3%, still chopping in a range that it's been in since July, but it's also not accelerating here. To be honest, this looks to me like it could very well break down lower here, a sign of a potential slowdown in the economy. And we've also got soybeans as well, which dropped around 4%. This means that a lot of maybe food inflation might be relatively neutral. Industrial commodities might be relatively neutral as well. But again, the key problem here that I want to emphasize is that we should be seeing sharp declines in all commodities. We need to see a hyper decline in these commodities to get inflation down to those target rates. Because if it just stays suspended here, it is going to take ages to be able to get down to that point where the CPI or the PCE are actually at 2%, where inflation is actually in a downward decline and starting to get back into that target range, where you can sit around 2%. Doesn't have to hit 2% exactly. I'm not making that claim, guys. I don't think the Fed is looking for that either. They just want to see a clear definition in the trend here. Right now, we're having a similar decline like we had in 2021 in a lot of these commodities, right? We've had many of these cycles here, right? And the Fed doesn't want to get caught up in another one of these booms up here if there's still too much excess liquidity. But the big thing we got to talk about here is the housing market. Now, this data here tells me everything I need to know about what the Fed is going to do. Because the Fed, if it wants to tame inflation, if it wants to get those inflationary metrics down, it's got to get, in this case, the cost of living down. More specifically, rents and home prices. This makes up in the CPI over 40% of the metric. And in the PCE, which is again easier for the Fed to tame, over 20% still goes towards housing and rental costs. So let's go ahead and take a look at some of the metrics here. Month over month here from July to August, this is one of the more up-to-date metrics we have on the housing market. It's a bit delayed compared to other things. In the month of August, we saw the biggest month over month expansion, excluding I think July of 2020, the biggest month over month expansion in growth in new home purchases from the previous month in over 40 years. Cutting back essentially months of progress in cooling demand in the housing market from its relative peak at 831,000 in a month. 685,000. That doesn't look like cooling demand to me that the Fed is going to need to tame inflation. Now, to be honest with you all, we'll take a look at prices are declining, right? We are starting to see here, in the economy that I'll go ahead and just kind of showcase some of the metrics here. We are seeing the price of these homes starting to decline here, right? If you take a look at the housing price index, it was down 0.6 from the month earlier to 395,000 for a single family home. And then along with that as well, the single family home prices down from around 403,000 all the way to 389,000. So we're starting to see like a clear downward tick here, but bear in mind, this might very well just be the seasonal decline that we tend to find here each and every year. You can see it clearly on the chart. What the Fed needs to see is a sharp decline. We need to zoom out a bit more and think about a longer term downtrend here like we saw in 2008. A clear topping pattern may take a long period of time to formulate here. And this leads me back to some of the other metrics that aren't so forgiving. Take a look at the price to rent ratios here. Now we can see very clearly here in the 1980s how when the Federal Reserve had to get really aggressive on monetary policy, this was what they had to do in order to cool the rental market. This is what's hitting a lot of consumers right now. I can tell you guys, I know a lot of people in the United States who are renting right now, they're feeling this pain, right? Rental prices have to come down much more dramatically to meet that of the traditional housing market. And we can see that the same thing happened in 2008. They ballooned up here towards around 130. Came all the way down to around 95 here on the index. Now we're sitting at 142.5 in the second quarter of 2022. This needs to see a sharp decline. And I can tell you guys, I don't know anyone right now who's telling me, yeah, it's getting better, Nick. It's starting to feel like there's a little bit less rental demand on the market. Considering the supply constraints that are in the housing market right now, it's going to take a lot more. It's going to take a lot more pain, a lot less excess liquidity in the system to get these inflationary measures down. Now, the Fed's doing the right thing by increasing interest rates, but it's got to start reducing that balance sheet. When people are still paying cash in hand to buy homes, when people are still taking mortgages at these rates because they know they have the credit, the ability to pay back on that credit and that financing, maybe due to increased wages or by having additional money on the sidelines, this is not a good metric here. We need to see a lot more defaults on mortgages. We got to see these interest rates getting jacked up even more aggressively in order to cripple the demand here and bring the Fed back in the driver's seat. I'm not looking forward to it. It's painful, guys. It sucks, but it is a part of an economic cycle, and it's the same reason why we're going to have pain when we had such exuberant, ridiculous periods of wealth creation back in 2020 and 2021. The reality is not everyone's a millionaire. The millionaires, though, on the other hand, those who make serious returns, are those who can be diligent and patient for opportunities. And I can tell you guys, while this may seem a bit negative here, I know coming here to the channel, I don't want you guys to come here for your daily dose of doom, and I don't want to be negative. I'm really, in the long term, a positive person. But we got to be realistic about this, guys. My job here is to be as honest as I can with you all. I'm not here to sell you on hopium, tell you about the latest, greatest altcoin in an environment where Bitcoin is down, 70-something%, looking like it's going to be moving lower. I'll let the other channels do that. I'll let all the other channels out there talk to you about leverage trading and all those things that are going to make you lose your shirt after already being down a decent portion. And we're not perfect here on this channel. I'm not perfect as an individual, but I want you guys to know that I'm in it for the long term. I'm going to be here during the bull and bear markets, and I want to do my best to help protect you guys in the sense of your investing journey. So hope you guys can see that. If you enjoy these videos here, if you stayed this long, you like my rambling, consider dropping a like. It's a great way to support the channel. Share the video with some family and friend members. And that'll be it for today's video, everyone. But thank you all so much for watching, and I'll see you all in the next one. Take care, everyone.